In this managerial accounting lecture, I'll be covering an example of how costs flow through the accounting information system. I'll be giving a review of debits and credits, and we'll be looking at some different classifications of costs that are useful in making decisions in a company. We'll start out with an example of cost flows. In this problem, we have a list of costs. Purchases of raw materials, $200,000. Direct labor for $270,000. We've got manufacturing overhead with a longer list of various items that are related to the factory, but they're not direct costs. You can't see these costs when you look at the finished final product that the company sells to the customer. For example, the indirect materials, indirect labor. Indirect labor might be the wages or the salaries that go to the janitorial staff or to the supervisors, people that don't actually work on the final product. Like, say, if this was a chair factory, they don't lay their hands on the chairs and make the chairs directly, but they're supervising people that are involved with that, or they're doing work around the direct making of chairs, such as sweeping around and so forth, cleaning. Then there's utilities, and it's got utilities, comma, factory. The reason it's put like that is because the company may have received a bill from the utility company for the $20,000, and the portion of the, or in this case maybe they got a bill for $100,000, and the portion of the bill that goes to the factory and is considered a product cost under manufacturing overhead is $80,000, and maybe the other $20,000 covers the sales office up front. Same thing with property taxes. You get one bill for your property taxes, and then you have to allocate a portion of that to the factory, which would be this $36,000 here, and another portion to the sales office or administrative offices. Same thing with insurance premiums and depreciation. You may have a lot of things that you depreciate in your company, but only the machinery that's related to the factory is going to be part of this $120,000 depreciation here. Eventually, all the manufacturing overhead items add up to $420,000. And it says, but some of the goods sold this month were produced in previous months. Some of the costs listed above were incurred for goods that were not sold this month. So this is basically talking about the need for inventory items where the balance at the end of one month carries forward into the beginning to start the next month. Therefore, cost of goods sold does not equal the sum of the above costs. If you were trying to figure out what is the cost of all the chairs that I sold, you wouldn't just be able to add up the $200,000, $270,000, and $420,000, the three product costs, to get the total cost of your chairs, because you didn't end up selling all the chairs that you worked on. Some are only half done. Others are finished, but they're just sitting in inventory waiting to be sold. And then it says, we need to determine the values of the various inventories. Now, before we get to talking about the inventories, I first want to give you a little bit of a reminder or a review regarding debits and credits. Here's a template that you can keep in mind to remember how to increase and decrease certain accounts with debits and credits. So we have a T account. The left side is always going to be the debit side, which we'll abbreviate as DR. And the right side of every account is the credit account side, and that's all that debit and credit mean, is left side and right side. That does not imply whether to increase or decrease the left or the right side. That's why you need this template to memorize whether you debit to increase or debit to decrease in the 5 major classifications of accounts within the accounting system. On the balance sheet, we have 3 basic types of accounts. So this above this dark black line, these 3 T accounts are all on the balance sheet. And everything below the black line is the accounts, general accounts on the income statement. So assets, a good way to remember what that is these are the costs of everything that the company owns, whereas liabilities represent everything that the company owes to someone else. And then we have an accounting equation that looks like this. Assets equals liabilities plus owner's equity. And if you can algebraically reverse that around, you can get assets minus liabilities equals owner's equity. So these two together, added together, liabilities and owner's equity, must be equal or balanced with what the company owns in its assets. That's why we, in every single business transaction, we record it so that this accounting equation stays balanced or equal, where assets is on one side, this is assets minus liabilities equals owner's equity, and this is assets equals liabilities plus owner's equity. Now, the debit and the credit side for each of these 5 accounts is like this. To increase assets, we do it on the left, or the debit side. And we do the same thing down on the income statement for expenses. To increase our expenses, we do it on the debit side. That's why I put these in a column. But the other 3 are on the opposite column, because to increase liabilities is done on the credit side, whereas to increase owner's equity on the credit side, increase revenue accounts on the credit side. And then we decrease these accounts, liabilities on the left, owner's equity on the left, revenue on the left, and we decrease assets and expenses on the right, on the credit side. So this template, if you keep this in mind, assets are similar to expenses in that they both increase on the debit side, and liabilities, owner's equity, and revenue are all similar in that they increase on the credit side. So we'll need to remember that and keep a kind of a template in our mind of that in order to finish up this cost flow example. All right, next we go back to the inventory accounts. And here we have 3 kinds of inventory. We have raw materials, or sometimes it's called direct materials inventory. Then we have work in process inventory. And finally we have finished goods inventory. So beginning with a good way to illustrate these accounts, these inventory accounts, is with a T account. So let's, on the side here, draw a T account, and we'll have since they're all assets, they're going to increase on the debit side and decrease on the credit side. And that'll be the same for raw materials inventory and work in process inventory and finished goods inventory. They're all three assets, so they're all three going to increase on the left and decrease on the right. Of course, to increase inventory, you'd have to do that through purchasing more. And to decrease inventory, you would use up your inventory in order to make your product or to finish your product. So we often will put these words on the left side. If we want to increase it, we do it through purchasing it and purchasing more. And the increase or decrease in the cost of inventory account, raw material inventory, is by using it to make the product. Same with, but with work in process, we have different names we use. So work in process is going to have on the credit side, in order to decrease work in process, we end up recording the cost of goods manufactured or finished. Okay, so cost of goods manufactured goes on the credit side. And with finished goods inventory, to decrease that, we're going to have cost of goods sold recorded on the credit side of finished goods. Those two, the cost of the goods, the chairs that we finished or manufactured, would be reflected on the right-hand side of work in process and duplicated on the left-hand side of finished good. This is going to also be our cost of goods manufactured. But when we sell those finished or manufactured chairs, then that decreases our finished goods inventory costs. All right, now they've given us some numbers, and in each one of these sections, they have a beginning inventory and an ending inventory. So beginning and ending, beginning and ending, beginning and ending. So we need to, an inventory accounts, every inventory account by definition has a beginning and ending balance. That means at the beginning of a period, we're going to start with $10,000 of beginning inventory in raw materials. So here's our beginning balance of $10,000 in raw material. And then we purchases of raw materials is $200,000, it says. So we add that to our beginning balance, and now we're up to $210,000. But then it says our ending inventory is $30,000. And to get to ending inventory, we have to draw a line here saying that the period is over, it's at the end, and they say that our ending balance is $30,000. So if that's the case, then we have to infer or calculate what is the right-hand side of the T account, the used amount, to give us an idea of how much raw material cost is being used. So we would do that by taking 10,000 plus 200,000 and subtracting off the ending inventory of 30,000. So we would end up with 180,000 as the amount of raw material that we used. So this would be 180,000, and that number would go right here, 180,000. Now with work in process, they've given us two pieces of information. They've told us that the beginning work in process inventory was 40,000, so that's our beginning balance of 40,000 at the beginning of the period. And then it's the amount that increases work in process is going to be our total manufacturing costs, and we don't know what that is, but that's going to be what this problem we're going to be figuring out. At the end of the period, in our ending balance, it's given that work in process inventory has $60,000 at the end. And then, of course, we don't know what the cost of goods, the chairs that have been manufactured or finished are. So here in the T account, when we have two unknowns, and we cannot solve that T account. We cannot complete it yet. But eventually those costs of goods manufactured, whatever they're going to be, are transferred out of work in process and into the finished goods now that they're finished. Finished goods has a beginning balance of $130,000 and an ending balance of $80,000. But we don't know what the cost of goods manufactured is, and we don't know what the cost of goods sold is. So we have to be finding those out to complete this process. Eventually, though, that cost of goods sold amount, whatever it is going to go on the income statement as cost of goods sold subtracted out of sales. Okay, so that's just to kind of orient us to where we're at in this problem. The next slide goes into more detail of the different T accounts and tells us how this would be reported in a financial statement. The financial statement I'm referring to is not the income statement yet, but it's the statement of costs of goods manufactured. That means the statement of the cost of the chairs that were finished. Not yet sold, but they at least got finished for the year ending a certain time. And in this financial statement, we've got direct material, a category for direct material section, another one for direct labor or wages, and then a third one for manufacturing overhead, which has several items in it here. But eventually at the bottom we have a section that leads us to calculate the cost of goods manufactured. So that's the bottom line. That's what we're trying to determine from this statement. Then once we know what the cost of goods manufactured is, we can plug it into the calculation of cost of goods sold. So it's eventually going to go right here. This is cost of goods manufactured that came off of the statement above and including the cost of goods sold beginning, or not the cost of goods sold, the beginning finished goods inventory and the ending finished goods inventory. If we have all that with the cost of goods manufactured, we'll be able to determine what is the cost of goods sold, and that'll tell us what number needs to go on the income statement, subtracted out of sales. So our goal is to be able to take all the costs that were provided for us in the beginning of the problem and to transfer them. Here's those costs that were presented in the beginning of the problem, and to set them up in a formatted financial statement here that tells us what is the cost of the chairs that I finished, cost of goods manufactured, and what is the cost of the chairs that I sold, cost of goods sold. To do that, we'll keep track of everything by using these T accounts. So taking the information that was already provided for us regarding the T accounts for the inventories, and let's say that I drop off the last three zeros, doing everything in thousands. I was told that the raw materials T account would look like this. Beginning inventory 10 plus 200 purchases minus 180 used gives me 30,000 ending. So if I put that into the T account here, I'm going to end up with beginning balance of 10,000 plus 200 increased on the left, 200 purchases, 200,000 in purchases of raw material, and that I ended up with 30,000 as an ending balance, so that gave me $180,000 of direct material was used. Write the word used right there. Now, talking about wages, direct labor, that is a liability, and so it's going to be increased on the right-hand side. And they tell us in the problem that our direct labor was 270,000. Direct labor, 270,000. So we take that and we plug it into the T account of 270 right there. And then we've got our manufacturing overhead, which has two sides to it. On the right-hand side, we allocate or apply the overhead with estimation to the product. And then when the actual bills come in for overhead, then we put the actual costs on the left-hand side of manufacturing overhead. So allocated amount, we'll have to add up all the overhead items, and we're going to make an assumption in this problem that we guessed ahead of time correctly what the eventual actual cost of the overhead was. Usually it doesn't work out that way, that you guess exactly the amount, but in this case, for simplicity, we'll deal with it that way, and then in a later lecture we'll talk about what happens when your allocated amount is somewhat different from what the actual cost of the overhead turns out to be later. Now, the amount that they told us that manufacturing overhead would total up to in the first slide was 420,000. If you add all these items together, they add up to 420. So that's going to be, let's say that that's also the amount that we applied on the right-hand side. And then later on, the actual bills came in like they listed for us, and we had 5,000 for indirect materials. We had 100,000 for indirect labor. We had 80,000 for factory utilities. We had 36,000 for factory property taxes. We had 9,000 for factory insurance, 70,000 for equipment rental, and 120,000 for depreciation in the factory. So those all added up to exactly 420, and let's just, for simplicity's sake, assume that we also guessed that amount that would be the amount of total overhead ahead of time. So in this case, there's no difference between what we allocated and what the actual cost of overhead was, so we end up with a zero differential, or no need to reconcile. Now, eventually, once we start making our chairs, three amounts have to get transferred into work in process, and that's the 180,000 used from direct material and the 270,000 in wages payable, and then the 420,000 applied overhead. All three of those have to be transferred into work in process. Work in process, however, is also a inventory account, and so it had a beginning balance, they told us, of 40,000 and an ending balance of 60,000, but we didn't know what was the amount that goes here. So on the left side of work in process to increase it. If we take these three items, though, 180, 270, and 420, and add them together, they add up to 870,000. So with a debit to work in process inventory and a credit to direct material inventory of 180, a credit to wages payable of 270, and a credit to manufacturing overhead of 420, we have a journal entry that transfers the costs out of these three primary accounts into the work in process inventory account. So this is the total manufacturing cost of 870 that is added to what we inherited last period in work in process of 40. And then at the end of the period, the present period, work in process is only is 60. So we can, by calculation, figure out on the credit side what is the cost of goods manufactured. So you take 40,000 plus 870,000, that's 910, and then subtract off 60,000, and you get 850,000 as my cost of goods manufactured. So what I've done now with these four T accounts is summarize pictorially what's going to be reflected in this statement over here. So the T accounts actually tell the same story as the statement of cost of goods manufactured. Take, for example, the direct materials inventory. Beginning balance of 10, so we would write that over here as well. Beginning balance of 10. But here I'll include the zeros. Then add purchases of raw material or direct material, and that's another 200,000. So now we're up to 210,000, which we never put that number on the income statement, on the T account, but it's implied. Then we subtract off the ending balance of 30,000, and we ended up with 180,000 used. Direct material that was actually used. Then we add on to that the 270,000 of wages or direct labor, and then we need to add on to that our total manufacturing overhead. Okay, so that's going to be all the things that they listed added up. So it's going to be 5,000 for indirect material, 100,000 for indirect labor, 80,000 for factory utilities, 36,000 for property taxes, 9,000 for insurance in the factory, 70,000 for equipment rental, and 120,000 for depreciation, all totaling up to 420,000. So if we zero in, looks like this. So if you add together the direct material used, the direct labor, and the manufacturing overhead applied, 420,000, you get a total of 870,000, and that is our total manufacturing costs, which was on the debit side of work in process on the T account. Then add to that the beginning balance of work in process, which if you look at the T account, it's 870, and add to it the 40,000. That's going to increase our total manufacturing costs to account for up to 910,000. Then I subtract off the ending 60,000 of work in process, and I end up with $850,000 as my cost of goods manufactured, which is the credit side of work in process. Now, how did it get on the credit side? It's there because it's part of a journal entry that is transferring the cost of the finished chairs out of work in process. It doesn't qualify to be there anymore because it's finished. So this amount of cost of the finished chairs needs to be moved into the finished goods inventory. So that same $850,000 is going to also, on the debit side, work its way into finished goods inventory. So one journal entry, a debit to finished goods inventory and a credit to work in process inventory, flows the costs out of one inventory account into the next. The finished goods inventory had a starting balance of $130,000. Add that to $850, and you get $980. But then you have to subtract off the ending balance of $80,000, and you end up with a $900,000 cost of goods sold, which is going to be transferred into the cost of goods sold T account and put on the income statement, subtracted out of sales. But what we did in this finished goods inventory T account here needs to be also reflected in a kind of a bridge portion of the statement of cost of goods manufactured. So all of this section here is the T account for finished goods. Had a beginning finished goods inventory of $130,000. And then we add the $850,000 cost of goods manufactured that we calculated above. So that's $850,000. Then add those two together and you get $980,000, and we can move that out to the next column, $980,000. But then we want to subtract off the ending balance of finished goods of $80,000, and we end up with a final number, cost of goods sold, of $900,000. So that finally is our number that's going to go to the income statement and be subtracted out of sales. So the answer to the question, which is, the question is, what's the cost of goods manufactured? Given this amount, these costs here, what is the cost of the goods that were manufactured? It turned out is $850,000. And what is the cost of the goods sold, not only manufactured but also sold? That's in this case $900,000. All right, and then finally, I just want to cover a few classifications of costs. You can break your costs up into direct or indirect costs. Direct costs that can be easily and conveniently traced to a unit of product or other cost objective. And an example would be direct material and direct labor. So those two prime costs are also considered direct costs. Everything that's not a direct cost is an indirect cost. So costs cannot be easily and conveniently traced to a unit of product or other cost object. There doesn't seem to be any logical connection between the final product and some costs that are termed overhead, manufacturing overhead in the factory. Okay, another way of looking at costs is by looking at what we call differential costs. And this is also differential revenues, where if you're trying to make a decision whether to do A or B, you take the costs of A and the costs of B and see if there's any difference between them. You also would take the revenues of Project A and the revenues of Project B and see if there's any difference between the two revenues. On a personal level, let's say, for example, you have a job paying $1,500 per month in your hometown, and you get an offer in a neighboring city that pays $2,000 per month. So you'd be getting a $500 per month raise, but the commuting cost to get there to the new job is $300 per month. So that would eat up part of your $500 raise. The differential cost, or the differential revenue, is the raise, $2,000 a month instead of $1,500, so it's a $500 a month raise. But the differential cost is it's $300 more expensive to take the job across town or to the neighboring city. So there's a $500 raise, but a $300 additional cost. It's still beneficial for you to take the job and net $200. Then there's opportunity costs, which you can probably relate to with this example, the potential benefit that's given up when one alternative is selected over another. For example, if you were not attending college, you'd be earning $15,000 per year, and your opportunity cost of attending college for 1 year is $15,000. So the amount that you're losing by not taking the opportunity to work is the cost of whatever you decided to do with your time, which is, in this case, going to school. And finally, we have the concept and classification of a sunk cost. Sunk costs cannot be changed by any decision. They are not differential costs and should be ignored when making decisions. So here's an example. Let's say you bought a car that cost $10,000 and you bought it a couple of years ago. The $10,000 that you paid out of pocket 10 years ago is sunk, because whether you drive it or whether you park it or whether you trade it or whether you sell it, you cannot change the fact that you've already parted with $10,000 in cost. And so you should not use that $10,000 to inform your decision for the future. It's a done thing. You've already finished and completed that transaction, and anything that happens in the future is unrelated to that transaction. So it's a sunk cost, and you should ignore it when you're trying to make future decisions. Okay, so that ends our lecture on cost flows and cost concepts, cost classifications, and cost terminology. So now we have a good basis to look at some of the different ways or methods used to determine the costs of our products and services, so that we can calculate how much profit we're making and being